The credit multiplier is a fundamental concept in the banking system. It refers to the process by which banks create money through lending. This process is crucial for understanding how money flows in the economy. When you deposit money in a bank, the bank doesn't just keep it in a vault. In our example, a $100 deposit is made. Instead, it uses a portion of that deposit to make loans to other customers. The $100 are split in two. $90 are lent to a client, while $10 are put in reserve. This is where the concept of fractional reserve banking comes into play. Fractional reserve banking means that banks are required to keep only a fraction of their deposits in reserve, while the rest can be lent out. For example, if the reserve requirement is 10%, the bank can lend out 90% of your deposit. This creates new money in the economy. However, the quantity of money increases by more than 90%. When a bank lends out this money, it spends in the economy. It gets deposited into another bank account, which can then lend out a portion of that deposit as well. In other words, spending becomes new deposits, and new deposits can be lent out again. This process continues, with each subsequent bank lending out a percentage of the deposits it receives. For instance, if the initial deposit is $100, the first bank with the reserve requirement of 10% has to set aside $10. It can lend out $90 if that $90 is spent and deposited into another bank. This second bank also has to set aside 10% of the $90 deposit. Hence, that bank can lend out $81. This $81 loan in turn can be spent and become a deposit in the first bank. This first bank then sets aside 10% of the $81 deposit, that is to say, roughly $9. The bank can grant another $72 loan. The loan will turn into a new $72 deposit into the account of the seller. The seller's bank will again set aside 10%, which is now $8. Look at the picture. You see that the first bank has $19 in reserves, while the second bank has $17. While the total reserves amount to $36, the total loans granted by the two banks are $314. However, the process can continue as long as every single dollar of the initial $100 deposit has not been placed into reserve. The amount of money created is equal to the initial deposit divided by the reserve fraction. For instance, if the deposit is $1,000 and the reserve requirement is 5%, the total amount of money created would be $1,000 divided by 5%, resulting in $20,000. If the reserve requirement is 20%, the total amount created would be $5,000. The credit multiplier is calculated by dividing the total amount of deposits created by the initial deposit. In the first example, the money created amounts to $20,000, while the initial deposit was $1,000, giving a multiplier of 20. In the second example, the money created amounts to $5,000 with the initial deposit of $1,000, resulting in a multiplier of 5. The multiplier can also be calculated directly as the inverse of the reserve requirement. For example, if the reserve requirement is 3%, the multiplier would be 1 divided by 3%, which equals approximately 33. This chain reaction is known as the credit multiplier effect, where the initial deposit leads to a much larger increase in the total money supply within the economy. Ultimately, the total amount of money created can be several times the original deposit, illustrating how banks play a crucial role in expanding the money supply through fractional reserve banking. To recap, we've explored the deposit loan cycle, the concept of the credit multiplier, and how banks significantly increase the money supply through fractional reserve banking. This process underscores the importance of understanding banking mechanisms in grasping the broader economic landscape.